Justin, we're going to talk about GME again, everyone's favorite stock. It went to the moon a few months ago, and Justin thinks it will not be just at the moon, but it will be somewhere around Shiba Inu and Dogecoin.
Yeah.
But Justin, what is it?
Tell us. Yeah, so like my basic thing is when it comes to GME is I don't think that they're good for it. So what that means is I think it's the short position has not been completely appreciated by the market, and that there are far more shares that have been sold short, or paper IOU shares of GME that have been issued than actually exist. So what this means is that if you believe this to be the case, as I believe it to be the case, you can directly register shares in your own name. So rather than a share being held in street name, you basically tell your broker, hey, listen, send it over to GameShares agent, a company called Computer Shares, and it gets put into your name. So it isn't, it's out of the street name. But the takeaway from this is that for the interim, I have transferred the majority of my shares over to be directly held in my name. I also left a few shares with Fidelity, who's the broker I use. And then I was considering some option plays on that front. And so let me just share my screen here, Josh, and I'm curious to get your opinion on this. Okay, let's see. Here's this.
Yeah, so basically Justin thinks that the short squeeze has yet to even begin, and we could see GME absolutely take off.
Yeah, and one of the key things in this is that when it comes to the mechanics of how shares are actually issued and how shares are actually settled, it's really, really, really opaque. So in other words, like let's say you're on Robinhood, for example, and you look to buy a share. You look in your analytics and you buy 100 shares of GME, 100 shares of Tesla, whatever, right? Just pick your favorite flavor. What you'll see in your account might not actually be a real share. And here's what I mean by that. What Robinhood or a similar broker might be doing is they might be saying, okay, well, listen, here is an IOU share for Tesla or an IOU share for whatever. And the reason they might do this is, let's say they assume that retail is always going to lose. And so retail's loss, that is your loss, will be their gain if they don't actually buy it on your behalf. So what Robinhood might say, not that I'm alleging that they do this, this is just for an example. Let's say that you pick up 10 shares of Tesla. Robinhood might simply say, okay, well, listen, we're going to say you've got 10 shares of Tesla. We will go short so you can go long. And we think that sooner or later, you're going to paper hand back down. If you paper hand down less for what you bought it for, your loss will be our gain, and we'll be able to pocket the difference in that regard. And I don't think the only one's doing that. So anyways, kind of a strategy I was playing with was writing covered calls, as you can see on the left-hand side of the screen right there. And so for anyone who's not familiar, when you cover a call, one call generally, or one option contract is generally 100 shares of the underlying. And so in this case, we could sell two covered calls at different prices, pocket the premium for that. But at the same time, if something does happen and there's some sudden run up, I don't want to leave too much. I don't want to miss on the upside. And so I've done a really, really big spread here where I've agreed to, or potentially would have agreed to sell 100 shares at 210 and 100 shares at 200. And then I have the ability to buy up to 500 shares at 800 on or before the 19th. And the point is, from all of that, I'd walk away with a premium of about, what is that, 1,048.45 cents. So anyways, it's just kind of a clever idea of what I've been playing around with to generate a little bit of income off to the side for GME while you wait for the inevitable to happen. The other thing, Josh, I wanted to share with you was an article. Oh, yeah.
You're waiting for the inevitable to happen. That is only if your thesis plays out.
True.
I'm someone who finds his thesis extremely improbable. I would not buy something like this because I don't believe in this thesis, and I'm not buying any. I hope that everyone who still believes in the thesis is getting rich. The reason why I really have a hard time believing it is if I was like Justin's whole thesis resolves around the assumption that more people are short GME than the rest of the market has priced in, or that they can even see. And I would question that, just because if everybody knew, if there was so many people short GME, many multiples above the float of the share price, because people talk around, other hedge funds or banks, they would know about this. And then if I was another bank and I knew that, say, the short interest was 1,000% on GME, I would just start floating out call options far out of the money.
Oh yeah. Sharks eat sharks. Absolutely.
Yeah, exactly. And they would definitely have the money to do this.
Yeah. So one of the things to consider, because like that, excellent question. This is my best guess as to what's going on, is that Let's say that you are a hedge fund and you want to go short. And the way I describe it is, imagine back last year, March 2020, the market first realizes that COVID's a thing, and boy, did we tank hard in March of 2020. Then let's say it rolls over to April, Mayish, June-ish or so, again in 2020. And you think, when I say you, that is, let's say you're a hedge fund or whatever, think that brick and mortar stores are on their last gasping breath. And you look around. So let's say you target, Bed Bath & Beyond, Best Buy, AMC, GME, the usual suspects. Let's also say that, just as you said, the last thing you want is someone looking over your shoulder, particularly if you have to file, let's say, quarterly disclosures with the regulatory authorities that otherwise might disclose that you're short a position. So the way you get around this is you can be creative. So, for example, the hedge fund, you, talks to a bank. And let's just say your primary broker or primary dealer is Merrill Lynch, so Bank of America, in other words. You might say, hey, listen, Bank of America, here's the deal. I want to go short 1 million shares of GME. But number one, I don't want people to know that I'm short. So I need to do it in a way where I don't necessarily have to disclose that I'm short. Merrill Lynch will say, listen, and again, this is all hypothetical. They can say, listen, we've got a solution for you. What we'll do is we'll enter into a swap agreement where we will pretend that you, hedge funds, are short me, the bank, 1 million shares of GME. Said another way, for every dollar the share goes down, the bank will pay you, the hedge fund, $1 million, because $1 times 1 million is 1 million. And likewise, for every dollar that the price goes up, well, you, the hedge fund, will owe me, the bank, $1 million. Makes perfect sense. So in this particular situation, it can be off balance sheet. And what's more, let's say it runs through Brazil or London, where the regulatory environment will be different. It's technically in compliance with the letter of the law, even if it's not in compliance with the spirit of the law. This takes us to the second part. Then Merrill Lynch, in this case, will turn around and say, okay, well, listen, we just went long on GME because just as the hedge fund is short, we're the opposite side to we're the long, which means that we, the bank, want to be completely market neutral. So we need to go short the market, 1 million shares of GME. So the bank then actually will turn around to its trading desk and say short GME 1 million. But the bank, for example, might not have to disclose the fact that they're short 1 million. Why? Because they're also long to the hedge fund 1 million. So sure, the bank has shorts over here, but it has the long over here and it's in balance. So the bank technically is neutral in this regard, and they'll collect a commission or whatever for doing it. Because just as whatever they might owe the hedge fund, they'll get from the market, or whatever the hedge fund pays them, they'll have to pay back to the market. So they're in balance. Here's where the problem comes in. If something were to happen where the hedge fund were to fail, and this actually did happen almost, more on that in a second, then all of a sudden the bank is naked short the market, in this example, 1 million shares. You see that? Because the bank wants to be completely in balance in this regard. But if the hedge fund blows up, the bank's still short, which means that the bank has a big ass problem on its hand. And if you go back to, this is January 23rd-ish, give or take, there was a hedge fund called Melvin Capital, where Citadel, who I believe is Melvin's primary broker, jumped in and infused them with, I don't know how many billions of worth of dollars in order to stabilize them back up. So Josh, I don't want to say to the skeptics, but to the people who would say, listen, this is an extraordinary claim, and extraordinary claims require extraordinary evidence. This would be probably one of the strongest things I could throw out there. If you look back to January 2020, which is called 2021, pardon me, the short sneeze, this is kind of what happened. So said another way, let's say through June of 2020, all the way to the end of the year, you had various hedge funds doing their own discrete things with their own discrete counterparties in the banks, trying to go short, 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 short. And you saw GME go down, 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 down to like, what, $2 is I think what it bottomed out at. But then retail started FOMOing in. And I think the takeaway from this is that retail is too stupid for the market, because the banks, or part of it, the hedge funds have always assumed that it's going to get to a point where we can create a self-fulfilling prophecy. The stock price goes down, people think the company is doomed, people sell their shares, the stock price goes down, they sell more shares, et cetera, et cetera, et cetera. And if it goes to zero, we win. That is, the hedge funds win. But when retail started jumping in with their stimmy checks and money that was the house's money.
Well, yes, Justin, I would say we all already know this. We all already saw this happen. GME already went to the moon. What is different now? Or what did not happen then that will happen now that you suspect?
So what's happened in the interim is that the hedge funds never closed their positions. And I can go into the details of why, but maybe there may be a good for a separate video. Let's just assume for a second that they didn't close their positions. But let's say they still had the ability to go short through the various manipulations of the market. So they still had the various tricks in their trades where they could issue essentially paper IOU shares. So as long as the DTCC and the NSCC, the National Securities Clearing Corporation, was on board with it, they can issue an unlimited amount of fiat GME. And so this would technically serve to clamp down demand, because if you're using price as your metric of whether or not the squeeze has occurred, which seems to be a logical thing, you could say, well, listen, yeah, sure, the price has been volatile. It's shot up to 300 a few times, but it's really been in a range between, let's say, 170 and 200, give or take. The answer to that one is, as long as the various market makers and sophisticated players have the ability to issue phantom shares and then cover their tracks through various regulatory tricks and shenanigans. Again, they are still within the letter of the law, even if they're not necessarily within the spirit of the law. You can keep this, you can kick the can down the road, for as long as it takes. What's different this time around, Josh, I think this is the answer to your question, is that you're seeing retail directly registered shares in their name. So let's say the year started out with about 50 million shares in the float. So in other words, 50 million shares were in street name. These shares could be loaned out over and over and over again through various tricks of the trade. But sooner or later, let's say that you take half of those shares off the table, say 25 million shares are directly registered in various names. Then all of a sudden, you might still be able to do it, but you have much less room to maneuver, because if you're going to cheat in the system, or you're going to manipulate the system, there's still certain rules, and you still have to dot your I's and cross your T's. But if your room to maneuver shrinks, then all of a sudden it gets harder and harder and harder to stay on the ball. Maybe it's thinking about like this. Have you ever heard the phrase robbing Peter to pay Paul? Okay, so let's say, for example, you owe a credit card company $20,000, but let's say that you've got 10 different credit cards. And let's just say that you know how to do balance transfers, without incurring any fees or whatnot. So what you could do is you could take the $20,000 that you owe credit card A, do a $20,000 advance on credit card number B, and use that to pay off credit card number A. But when credit card B needs to be paid off, you do an advance on credit card number C to pay off B, et cetera, et cetera. And if you have 10 of them, it's pretty easy to do. You just kind of hop along and hop along and hop along. But let's say you only have 3 credit cards now. Then you've got to be really, really careful, because you can still kind of do it, but it's much smaller to maneuver. And you only have 2 credit cards to do the balance back and forth between. If one thing goes wrong, then the train suddenly derails. And that's what I think is going on right now, or what I suspect will happen. If enough people directly register their shares, it destroys the DTCC's ability to continue to prop up the phantom paper market. If anyone watching this is a precious metals bug, it would be akin to, let's say, withdrawing silver or gold from COMEX. So COMEX people no longer believe the paper claims can be backed up by the actual metal, and hence, you'll have a big problem on your hands. I'm sorry, that was a very long rant. Did I answer your question?
Yes, I understand that. Okay, so now let's go into what if this plays out. All right, and GME goes to, you have suspected, as much as $30 million a share. And
yeah. Yeah.
Yes. Well, if that happens, you always make the claim, well, the Fed can't print GME shares. And yes, that is very true. They can't. But GME can. GME could issue as many shares as they want. So this price starts running up, and then GME could just issue $10 trillion worth of shares. The banks and the hedge funds who are short could then flood in and fix their problem, and all the GME holders would be screwed in the process.
Okay, gotcha. So let me say it back to you to make sure I understand what you're saying. It's like, Justin, let's say, for example, I'll leave the dollars out of it, but let's just say that right now, the open short interest suddenly comes due for whatever various reason, and all of a sudden there's this massive squeeze, and basically there are 50 million shares that are not locked up in the float, but we need 550 million shares. In this particular scenario, what's to stop GME from issuing, let's say, the 500 million shares, even at an astronomical price, in order to alleviate the short squeeze, right? That's the answer to the question, or that's the question you're asking, right?
Exactly.
So what I would say is we don't actually know what the current ownership is. So let's say, for example, retail has been flowing in for the past year, give or take. And let's just say that when you look at the percent ownership right now of GME, let's just say retail owns the float by a material amount. For GME to actually go through and issue more shares, they would have to put the vote to the shareholders. In other words, or they would have whatever the corporate documents say, let's just say half. I don't know if it's half, but just pretend that it's half, would have to agree to the new issuance. And so in this particular situation, if it was popping up that much, there'd be an incredible amount of interest from everyone involved. And what's more, if you, let's say, had half of the people, retail in this case, again, FOMOing into GME, who basically refused to issue new shares, like, oh, no, we're good. Management's hands would be tied. Right now, there's about 75 million and change of shares outstanding. 25 billion are locked up with insiders, whatever, leaving the float of about 50 million. Okay, let's say the GME corporate documents say GME is authorized to issue up to 200 million. So technically there's 125 more million shares based upon the simple math that GME could issue. Sure, they could issue this 125 million shares, again, assuming my numbers are roughly correct, but they couldn't go beyond that unless there was an amendment. And that probably needs a approval by the current shareholders. And if the current shareholders are motivated by greed, why would they approve it in the first place?
There has to be a shareholder agreement
Yeah,
for, and there is one on GME.
absolutely.
Okay.
Absolutely. Actually, too, Josh, we'll circle back to that in a future video. I'll pull it up, dig it up, and we can go through the actual.
I was just looking up to see if your point could be disproven, but that is true. If GME has a shareholders agreement, then then it is a vote on if they can issue more shares or not. So, all right, well, that would disprove that. So
Yeah.
if it
But
does
good
go up,
question.
yes.
Good question. Good question. The other
Wow.
thing
All right. Yeah. Continue.
Yeah. So the other thing I would say on this front is that people also say, and this is another good critique that comes up, and I'm glad it's come up because I think it's very interesting. Let's change gears just for a second and talk about the Fed. I maintain that the Fed wants the ability to cross the chasm. That is, I think the Fed wants to be able to put currency units directly into your account, my account, and business accounts. But they need a reason to do
Yeah,
this.
just for example, the Fed right now, money can be created in two ways. Either the banks lend money and money's created, or the government issues debt and the Fed buys that debt, like we saw in 2020 with where physical stimulus going out to the economy. Right
Yeah.
now, the Fed cannot directly put money into the accounts of non of people.
Yep. The
So
Fed, yeah, the
so
Fed cannot print money that you and I can
what
spend.
Justin's talking about is a central bank digital currency, to where the Fed could actually put dollars into the account, and we both agree that this is coming someday in the future.
Oh yeah, the Fed wants, the Fed's going to get it. But what I'll also say is this too, is that if the Fed ultimately will stand behind, so let's say something like this goes on or whatever, right? So let's just kind of like game this out. There is some market event where the people who are short are no longer able to continue the propagation of their short. Suddenly it gets wind and the system breaks down. And all of a sudden it's like 2008 again, or even going back before that. So it's a collateral problem. In 2008, nobody knew if mortgage-backed securities were actually worth anything and who was holding them. Or you go back to long-term capital management in 97, 98 when it blew up. The point is that the counterparties don't trust each other because nobody knows who is the counterpart. Remember, we're talking about banks being thing. If a bank is suddenly short because their long hedge fund blew up, bank's got a problem. So my suspicion is in this particular situation, this gives the Fed the excuse, or gives the politicians the excuse, so that they'll give cover to the Fed, where they can say, okay, listen, here's what's going on. There's obviously a serious problem. How on earth could we have known this was coming? But don't worry, here's what's going to happen. We, that is the Fed, will bail out the DTCC. We will guarantee settlement at whatever the cost is in order to close out these positions. So that's why I say this silly number of like 30, 50 million or whatever a share. So the Fed just types that number in, sends it to the DTCC, or sends it to, the very clearing corporation, what I just referred to as the nebulous DTCC. And then that suddenly gets into the hands of, people who actually own GME shares, and they're bought off, to an obscene amount. But at the same time, when this happens, consider this. You suddenly have a massive currency event that's going to trigger like the mother of all capital gains tax. So if you were the government and you saw this, well, wait a minute, do we want to stop this? Do we want this to go through? Because if we let this go through, number one, we can finally get the inflation we want. We can look like the good guys because we're coming in to save the market, stop the meltdown. And what's more, what's the debt of the United States right now, Josh? How many trillions of dollars? Like,
Too many.
Well, whatever, right? Or back up. Let's just say it's $10 trillion. I have no idea. Let's say it's $10 trillion.
I don't know.
Let's just say the government says, okay, yeah, we'll print, yeah, fine, we'll buy out. We will let the DTC close on the short position for $50 trillion. Just type. There we go. And let's just say you take what's long-term capital gain? Pardon me, short-term capital gains. It's like what, 37%, I think. Let's just say let's just say it's 40%. Let's just say it's 30% to keep the math simple. So that's going to be of 50 million. That's going to be 15 trillion, like that, of tax revenue that just suddenly materializes on this regard. It's going to be inflation out the wazoo. But my point is that for those who are in the government, I think there's a way for those who have access to see all pieces, I think there is a path forward that would solve many of the government's problems and achieve many of their objectives. albeit I say this cynically and with, my tinfoil hat, of course.
Yeah.
So,
And this is something that is outlandish, right? Justin
yeah.
knows it. And it is a crazy thesis, and I love it. I'm personally not someone who would invest into it, but if it happens, I mean, I would be absolutely ecstatic
Yeah.
because I think I would do okay as well.
Yeah, and Josh, let me just share this. So we were talking about this before, so just ignore this over here, and let's look about this. So this was an article came out today from, I think it was Market Watch or whatever, right? So it goes back to Robinhood. And if you remember, Robinhood disabled the buy button for your protection back in the day. That when I say back in the day, I mean January of 2021, because they had a margin call themselves. Anyway, so the title of this is that opinion: Robinhood might have actually democratized finance, but it's kind of eating its own tail right now. And so I'm going to scroll down just a little bit and share this highlighted part with you right here. Just a second. Okay. Because Robinhood halted trading on the volatile meme stocks, and again, this is circa January 2021. The squeeze ended with a whimper, and 10F, the Robinhood CEO, co-CEO, or excuse me, co-founder and CEO, ended up in front of Congress explaining why his company was caught unaware by not having enough cash on hand to handle the action. Sounds like a margin call, right? Sounds like a not enough collateral problem, right? Can you think of anyone else who says we're kind of facing a not enough collateral problem? But we'll set that aside. Anyways, you also had to answer some uncomfortable questions about how Robinhood itself makes half its revenue from selling trade order flow to market makers like Citadel Securities, a firm founded by Ken Griffin, who also founded Citadel LLC. Also of note, Josh, is I don't have an article handy right now, but you can do your own research. That Citadel and I think it's Alex Cohen bailed out Melvin Capital, the hedge fund, who was short in a very stupid way, GME when this happened too. So again, I can point back to that for that. That's actually empirical, verifiable evidence from January earlier this year. Anyways. Oh, excuse me, right here, yeah. A massive hedge fund that bailed out Melvin Capital with the short sellers targeting Robinhood's own users, right? So right there in the article. Let's continue down just a little bit here. To do a quick perusal of Finance Reddit in the spring was to come across copious examples of users sharing screenshots providing that they had ditched Robinhood for new brokerage. In recent weeks, this trend has intensified, with users claiming to have moved their meme stocks into direct registration. That's what we talked about a little earlier, with computer shares in this case being the registered agent for, the direct register for GME. So as to keep them off limits from short sellers looking to borrow. And again, that's kind of the theme I said before, where if, let's say, shares held in street names serve as collateral that can be loaned over and over and over again to facilitate unlimited or almost unlimited short selling, the way to stop the unlimited short selling, in other words, stop the price suppression, is to remove the collateral from the system. And that's what you just have to do. And sooner or later, it's going to get narrower and narrower and narrower, where they're not going to be able to maneuver, or they're not going to have enough room to maneuver. But anyways. That's also what led them to appear to be a percolating liquidity crisis for certain meme names, but we'll talk about that another day. So even in the article, like there's a wink and a nod to what's to come, but they can't, let's say it at a 1-to-1 ratio right now. Anyways, that pretty much comes up last. And the last thing right here is the big narrative around meme stocks is that interest and volume is fading, which is sort of true. So again, this is the mainstream media narrative, and we all know what a paragon of virtue and truth those guys are. But again, not to get sidetracked. But that take fails to fully grasp the large group of diehard retail investors who are not going to give up their quest for MOAS, which stands for the mother of all short squeezes, and will continue to create chaos in the market when it suits them, using all the tools they've accumulated in the last 2 years, with options being by far the most popular. And if you look on the left side of the screen share right now, that's kind of like me playing around with that in that situation. Anyways, and just a shout out to Fidelity as well in that situation. So anyways, we've really gone on for a long time, and I feel like we're probably over our limit, but Josh,
do you want to stop screen sharing? I think that your thesis was laid out perfectly. If someone wanted to get into this stock, because they're buying your thesis and they're saying, okay, if this plays out, I really like the asymmetry. I can put in a few dollars and potentially 20, 30x my money. So you would suggest that they don't just buy the stock, but they carry the stock under their name. Can you just explain that a little further before we end?
Yeah. So what I would say is, obviously, do your own research, and please do. This is not financial. This is what I do. I just throw it out there in case anybody else wants to go for it, but please don't consider this to be financial advice. Is that like GME's trading at, I think, 180-ish or so, or let's say it's 185 right now. Maybe the idea I would throw out is maybe buy, let's say 5 shares of GME. So that's going to be like about $1,000 and change or whatever, right? And if that's a lot of money to you and you can't afford to lose it, then you shouldn't be playing in the market to begin with. But whatever, right? Let's just say like it's like a weekend in Vegas. That's your gambling money. That's your gambling money. So let's say you buy your 5 shares. Of those 5 shares, maybe you directly register 3 of those 5 shares. So you send 3 over. You've got 2 on Fidelity or some broker, but make sure the broker actually has the shares. Fidelity is probably kosher, but like the Robinhoods, the Schwabs, even like it's kind of iffy on that front. But the point is that if this thing were to pop off, well, I mean, you've got this tremendous upside. And worst case scenario, let's say GameStop crashes back down to, I don't know, $50, 30, $20, $10 or whatever. Okay, well, fine. It's like a weekend in Vegas. You lost some gambling money. At least you can say that you did it and went along for the ride.
Mhm.
So that being said, that's kind of how I would talk about that. But the one thing I would definitely say is make sure whatever you do buy, should you choose to buy some, do everything you can to hold the shares in your own name, because that guarantees you that you actually have a real share, not an IOU share.
Okay, Justin. See you next time.